My name is Mark Carrington. This is the first in a series of interviews under the tagline, What Did They Mean? And will be launched exclusively on Steemit to help people think about investing and investing philosophies. So you may be wondering, who are the they? Well, the they in particular are the media. Now, I have an investing premise which is really important, and it's based on some data. I love data. At the end of the Second World War, media ownership in the United States was in the hands of about 5,000 entities, 5,000 individuals, 5,000 businesses, 5,000 entities. That's pretty well 100 per state. And if you think about the local radio station, the local newspaper, the local TV station, it was spread around pretty much 100 per state. That gives us 5,000. By the early 1980s, this had consolidated down to 50 companies. So 50 companies controlled the media in the United States. That's pretty well one per state. You may be surprised to find that the number, and there's a chart which has appeared here, has come down by 2004, consolidated to 5 corporations. So 5 corporations control a majority of the US media. Now, as an investor, and quite frankly, as Joe Citizen, who has just come through the election of 2 weeks ago, you might be wondering how they are positioned whenever they say something. So this series is about what did they mean? And I'm trying to draw conclusions from the data that comes from the markets. Now, market data ultimately captures all the information that is available in the market. It's a consolidation of everybody's thinking that all comes together into one place. And then what is the media? The media is a consolidation of thinking from the owners of the media corporation, and second, the opinions of the particular individual who is talking or writing at that particular time, and his editorial team that sits above, his or her editorial team that sits above him. And the series is going to be simple. I'm going to take, on a regular basis, a headline and trying to pin down what the markets were actually telling us, what the headline was trying to tell us, what the media was actually getting us to think, what it was they were thinking, and how they might be positioned. So that's what the story is. And I'm going to I draw very heavily on, there's a book that's been recently published by Dr. Pippa Malmgren. She's a British lady, if I recall, who has been an advisor to politicians both in the United Kingdom and in the United States. And her book is called Signals. And it's how everyday signs can help us navigate the world's turbulent economy. It's a really good book to read because ultimately that is what she is trying to do. She's trying to look at events, look at instances, and then ask the question, what did they mean and what was going on? Now, the next part of my introduction is, I'm talking from Sydney. It's Monday, the 21st of November. It's 3 o'clock in the afternoon. So here is the 21st of November and 3 o'clock in the afternoon. And now here's my headline. The headline is on Bloomberg Markets. It's a headline that emerged over the weekend. November the 19th is the date. And the headline is, Bond Traders Sound Inflation Alarm Amid the Worst Rout Since 2001. Now, I need to be a little bit wary about using Bloomberg. It is a big media corporation, but it is owned by Michael Bloomberg. So it's dominantly owned by Michael Bloomberg. So you may not fit into my challenge about how are the media companies positioned. But what I will do is I will open a tab and we'll take two of the words that were in that headline, I'm going to use the word rout and bond because those feel like media type words that are trying to evoke a response. And I'm highlighting the news headlines here so we can see where the pointer is on news, and these are the headlines. And because I'm sitting in Australia, these will be somewhat dominated by the Australian newspapers, but we do not have to be surprised to find that some of these newspapers are owned by the same corporations that own US corporations. But as we go down the list, so we'll say markets live, Trump trade loses steam, bond rout spells end of low rates, how to stay ahead of Trump's bond rout in bonds market unlikely to have gone far enough. Amid the bond rout, financial expert expects Jamaican investors to hold back, Trump-inspired bond rout. So there are a bunch of things there. Is the media are trying to tell us that the bond rout, so that's the decline in the markets in fixed interest bonds, so prices in fixed interest bonds have been coming down, and they have been coming down, has been triggered by the election result from 2 weeks ago. Although this article says bond traders sound inflation alarm. So the truth is going to lie somewhere in between the two. It has either come from the election result, or it has come from the inflation alarm. And what I'm going to look at is I'm going to look at the data to see which has come first and which has come second. So I'm going to start using charts. It's going to be a little bit interactive because we will so the first chart is it's 20-year treasury bonds. So these are US treasury bonds, and you can see on the chart there's certainly been a rout. There's certainly been a major decline. This is when the election result was here. So the first thing we can absolutely say is that the bond rout had nothing to do with the election result. The election is here and the top of the market was here. So this is June or July of this year. So what we do know is that something else is going on that has driven this decline in bond prices. All that has happened, or what appears to have happened, is that the election result has accelerated something that was happening anyway. So the next thing I'll do is I want to overlay onto this chart how the stock market performance has actually been working. And I want to do that over quite a long time frame. So I'm going to squeeze the chart up. I'm going to change the data to weekly. Make sure it all fits in that chart. And so we're going back from 2008 through to current time, and here we can see that big correction. Now, just to understand how prices work, this is the price of bonds. So when this chart is rising, it means that interest rates are falling, and when this chart is falling, interest rates are rising. So now I'll overlay onto this an index of the S&P 500, so the index of the top 500 stocks in the United States. And what we expect to see here, and we'll start on the left. Interest rates are falling here and the market is falling. So it's an inverse relationship, and then as we see the rates beginning to rise, we see the market rise. we see the rates falling, we see the markets rise. So it's an inverse relationship, and it seems to be working to a degree. Over here, hard to say that it's this may just be a single continuation, but this big drop off down here, we see things continuing to run. We'll see this drop here, and we'll see the market leveled out and then fell off. So this is not totally consistent, and the market's been tracking sideways. And then we've got this drop here, which is precedes the election, and we've got the market go sideways and then jump. So there is no doubt in my mind that this jump here has to do with the election result, and that's because the market has changed expectations, and some of the money will undoubtedly have gone from here to here. So that will explain a large part of the flows. But let's go back to our article and let's dig into this question about inflation. Now, I've pulled up a website which is called tradingeconomics.com, and it's listed in by size of economy: the US, Europe, China, Japan. And what I'm going to click on is the individual data on inflation rate. And this website is very neatly pulls up US inflation rate. Not really sure what definition of inflation they've used, but it's not really important. So what we can see, so this is year to date, we can see that it's gone from 0.5 to 1.6. So totally clear that inflation has been rising. And in fact, we had a spike here in January. Now let's just go back a little bit and to see when this thing actually started rising. So that's a 1-year chart, and we can see from January 2015 it has been rising steadily. If we look at a 5-year chart, and let's go and pin down where the bottom of this is. So the bottom of this is 2014, this is 2015, looks like the beginning of 2015, maybe this month here. So inflation has been rising pretty well since then. Now, do the markets actually know about this? And so we'll go back to our TLT chart, we'll get rid of this index, we'll go back to a daily chart, and then let's see when this thing turned around. So basically, when we see inflation rate beginning to rise, interest rates should also be beginning to rise. So the 20-year bond rate, this is the peak here. So that is July 2016. So that is the peak, July 2026. So the bond market was starting to reflect this change of interest rates in July, which is coincident with one of those peaks in our inflation data. So if we go back to, this is beginning of January, this is the bottom here. So it's coincident with this bottoming here, which is the middle of 2016. But the 20-year bond rate may not be the total home for this information. I'm going to have a look at short-term interest rates. So let's explore this on short-term interest rates. Now, to do this, I'm actually going to step across to my trading platform. My trading platform is at Saxo Capital Markets, and it gives me a wide range of instruments that I invest in. And I'm going to start this with the fund called TLT, which tracks 20-year plus year Treasury bond fund. So here's the chart. This is 1 day's worth of data. We'll step back to 1 month, and we will see, here's the election result, 9th of November. So that's the 9th of November. So we'll see the election result certainly created a increase in interest rates. So when this goes down, interest rates are rising. Step back to the 3-month chart and we'll see where was the peak. September, it was certainly a high there in August. Let's go back to a 6-month chart, and there we'll see the high there was the 8th of July. And if we go to the 1-year chart, we'll see that was the high. So the long-term interest rates were showing us in July that the market had turned. You can only really say the market's turned is when you've taken the sets of lows down. So it's really from here. That's so from the middle of July is when this market turned. Now let's have a look at short-term interest rates. So the first short-term interest rate I'm going to look at, I've typed in here euro dollar, and I'm going to use 3-month euro dollar. So this is short term, it says 3-month interest rates. This is a futures contract, and I picked the June 2020 contract, and I've picked that for a reason, is because I actually have investments in that contract. So we have the 1-week chart. We'll step back to the 1-month chart, and we'll see there on the election day we got a run up in price and then a run down, and this certainly triggered something there, and the price had been tracking sideways up until then for the month. But if we look at the 3-month chart, that's the 4th of November, this is the 8th of November, so we can see this market had already turned over before the election, and there's a peak here and there's a peak there, which are September and August. So let's step across and have a look at a 6-month chart, and let's see where that peak was. So there's the August one, and there was one here, August again, and here the peak is at the 8th of July. So that's pretty well coincident with the TLT chart. So I'm going to reset it to 1 month, and I'm just going to have a quick look at European interest rates. So the contract is, so again, 3-month interest rates in Europe, June 2020, and we'll certainly see that same spike when the election was happened. But on this 1 month window, you can see that things are already moving down. There's a bit of a peak there in September, a bit of a peak there in September again. So the 6-month rate, or certainly be confident that September is when European interest rates started moving, and prior to that they'd been plateauing. So I set that aside for now. I just want to step across back to our chart on interest rates and just have a look at those interest rates. So we'll go back to where we started. Remember, euro area, click on inflation rate, and we'll see there that we actually had negative interest rates April and May, and it had started turning by there and certainly cleared those highs there. So the markets were telling us September, well, that's pretty well where it is. Let's look at the 1-year rate. So we can see this is we see January there was a bottom here, but in fact the rates were lower below then. So the bottom of European inflation rates was sometime in the middle of 2015, but that was not showing up in the interest rates. And then the last chart I want to show you is this is a chart from St. Louis Federal Reserve. They have a massive amount of data, and this is what they call the 5-year forward inflation expectation rate, and the definition is given to us as is a measure of expected inflation over the 5-year period. And we can certainly see here this inflation expectations were coming down, and they turned in February, and then they ran up, and then they turned again. This is probably coincident with the oil price change and June, July. So the expectations were already in the market of the turn somewhere in the June, July. So we certainly have seen that in the markets. And then one other place to see this is on this chart here, which is called the Merrill Lynch US High Yield Option Adjusted Spread. And this is basically the difference between the spreads on interest rates on high yield bonds, high yield corporate debt compared to government debt. And this chart is really interesting because basically what that tells us is that when interest rates for normal debt are beginning to rise, the gap between high yield and low yield starts to close. And this chart is absolutely telling us that that peak was in February, which is very much what this chart was telling us here, the 5-year forward expectations. So the markets have been telling us a story that inflation is rising, and the information is there already in the markets. This analyst at Bloomberg says the bond traders were identifying inflation as being an issue, and we'll actually see he has a chart here. Inflation expectation surge. Trump promises to drive break-even rate to the highest since 2015. There's the election, and we can see there this is totally consistent with what I have just described the markets have told us. So this media analyst is telling us what is actually going on, whereas these analysts are actually trying to tell us that this has something to do with the election result. So given that, is how do we think that the media are positioning? And my guess is where they are positioned and we're going back to treasury bonds. They are short interest rates. They're trying to scare people to sell out, and they are long the equity markets. So what the media is trying to tell you to do is to keep selling your bonds, because they are actively selling bonds themselves and will profit. The more panic they create by using words like rout, the more money they will make. It might be a little bit of conspiracy theory thinking going on there, but it's a view. So that ends my first video in the series on what did they mean. Look forward to producing the next one. I will just pick out a headline and try to work out what did they mean.